finance for about a decade. Sorry, I've been with Santander for about 5 years, a little over. In Philadelphia for the past few years, so I'm a transplant here. I'm not from here, but I always like to, if there's anything going on at PCDC, there's always a wealth of information that's out there. I'm passionate about providing it. So thank you, for having us be a part of this. And I'm happy to give you all the information I can in the time that we have today.
Awesome. Xida, do you want to go next since you're right next to her?
Hello, my name is Xida. So I work with Kaylin. We are in the same location, 1101 Market Street. We are very close to Chinatown. We have a lot of clients from the community. I'm the operations manager here. So I manage day-to-day operations in the branch. I have been with Santander for more than 3 years right now. I'm from New York. I live in Brooklyn for 9 years, and then moved over here. So I'm really happy to work again with PCDC. We have worked in the past with them. I'm really excited about this opportunity, and then we will work together probably later. All right.
Awesome, thank you. And Dennis?
I'm Dennis McNichol. I'm a mortgage loan officer with Santander. Been with the bank for 17 years. I work with the gentlemen and the ladies at the branch at Reading Center on 11th and Market. And I've been involved with PC, various seminars for them on home buying.
Excellent. I also see David is on. Do you want to introduce yourself as well as the branch manager? Okay, maybe.
Dave's the boss.
Step away.
Okay, he just stepped away, but as Dennis said, he works out of the 11th and Market branch as well, very close by. So, we are really here to provide you information, which we hope that you get used to walking into any bank to get this information as well. There are plenty of people inside of the bank that can offer you any information on banking, budgeting, credit, any questions you have. We want you to feel comfortable about coming in. All right, Dennis, do you want to kick us off?
Sure. All right, we're going to be doing a credit and debit workshop, and we want to show you the difference between what credit is and what debit is. And the big thing, credit is very important in your life because everything that you do revolves around your credit score, whether not just buying a house, but on other factors. If you're trying to get another credit card, if you're trying to get a credit card, you're trying to get how to get credit and how to keep your credit up, your credit score up. And it's very easy to keep your score up. It's basically the one factor. You borrow money, you pay it back. That's all it is in a nutshell. Okay? Next slide. All right, so there's credit, debt, and interest. Credit is basically you're borrowing money now and paying for it later. All right, so you're going to get gas. You're using your credit card. You're getting $30 worth of gas. You buy it on Wednesday. You don't have to pay it back until 30 days until your bill comes out. Okay, so it's buy now, pay later. That's the big thing. Okay, all right, your debt. All right, it's the money that you owe. So you bought $30 worth of gas. You owe $30. That's what you owe. That is what your debt is. Now down the line, if you appear on your credit report. That's where your credit score comes from. You also have other debt that you will have. You know, you might have debt on, on not just student loans, but if you take stuff out to buy books, you know, that would be debts that you might owe. All right. Or if you have child support, that's another debt. There's things that don't appear on your credit report, but it is still money that you owe. All right. You are going to pay interest, and interest is basically it's a fee that allows you to use the credit. So if you use the $30 worth of gas, and the thing is, if you don't pay it within the 30 days, you're going to get charged an interest rate fee. And it all differs. The credit card interest is different than a mortgage interest or a car payment interest. But what it is you are paying more. If you borrow $100, you might be paying 10%, which would be another $10 on that. It is interest that you have to pay back. All right, that's what has to happen. Okay. All right, this is a question for everybody. There is no such thing as good debt. True or false? Can we get an answer out there? Hello? Anybody out there?
It's okay. This is good debt. Thumbs up if you think that's true.
There we go.
There we go.
Oh, somebody's saying no.
All right, I see a couple thumbs. I see a couple thumbs down. So some people think it's false. So let's see what it is.
There is no such debt. What happens when you have good debt? That's showing the fact, that's helping your credit history. You borrowed money and you paid it back, or you paid it back in a timely fashion. All right. When you're doing that, that is showing that you're trustworthy. All right. If you borrowed $50 to buy gas and you paid it back, we'll lend you $100 to buy more gas. It's helping you out. It's building up your credit history. So yes, there is good debt. And the whole thing that we're always going to say during the whole time is, if you borrow money, pay it back, and you will look good in the eyes of a banker. That's the big factor. Borrowing it and paying it back right away, you look very good, and it increases your credit score. Okay. Why do people have credit? Why do you have credit cards? Okay, it's convenient. You're saying everything just tap the credit, or just use, insert the chip, swipe. All right, it's very easy. All right, it's safer than carrying cash. You don't have to carry cash wherever you are. All right, just if you have that card, it's going to something that'll help you out. It's showing that by having good credit, it's showing that you're trustworthy. So if you have a credit card, you have credit, a merchant will see that you have this credit card, and they will say, okay, fine, you have this, you're in good standing. I will sell you the goods on credit. Something to have in an emergency. If your car breaks down, if you're stranded, if you have to get, a hotel, something along those lines, people will only deal with you if you have a credit card or if you have credit. Once again, it's showing your trustworthiness. It's showing that you borrowed money before and you've paid it back. So all it's doing is it's building up your trustworthiness. You're a good risk in the eyes of the merchant. They want to see that. And a lot of them will say this is good. They know they're going to get paid because of that credit card. That's what they want to say. Okay. By using the credit, as I say, you buy $30 worth of gas, you pay it off, you continue to do that. That's building up your credit history, and your credit score. By doing that, it makes you worthwhile to go out. You have good trustworthiness. You'll get a lower rate when you're going to get a car, when you're going to get car insurance, when you're going to get to to buy a house or to get homeowners insurance. That good credit history and what you've built up helps you out and helps you to get lower rates and lower payments. That makes it easier to impulse purchase. Never really want to go on impulse purchasing, but it is something. If you see something that you have to have, that you need it, and you don't have the cash on you, you can use your credit card. All right, you can do that. Or you can buy something that you're stretching yourself a little bit. Hey, I was only going to spend $100, but it cost $120. So you can use your credit to do this because, once again, as I'm saying, it's showing you're trustworthy. It's showing that you have good credit. It's showing that you've paid off your debts. So it's helping you out. It's helping you to do these things. All right. Another factor when you're looking at something, if all of a sudden, if you have an emergency and you bring your car into the shop and they say, you know, you only need a new tire. And then all of a sudden they find something else that's wrong. Well, instead of you going and thinking I have to pay $100, it's now $200 because you have that credit card, that good credit. It will allow you to pay for that. All right. The merchant will take that. They'll see that and they'll use that. It's all building up trustworthiness that you have. That's the big factor. It's showing that you're not a credit risk. The merchant will get paid. They will get their money if they do work. Now we have two different cards, credit card and a debit card. All right. On a credit card, once again, you're using it, you can use it to purchase goods and services. What's going to happen on that credit card is you will get charged interest on that. So if you borrow $100, you will get charged interest on that $100. Now, every 30 days, you're going to get a bill. Now, you're going to have a minimum. You can always pay it off, but you do have to make a minimum payment, which is a portion of that amount that you've borrowed. So if you've borrowed $100, you can pay the $100 off, or you can pay the minimum amount, which would be $10. Okay? As long as you pay, that's keeping your credit in good standing. That's what you want to see. All right? You want to always pay it. As soon as you get your bill, pay your bill, whether paying it completely off or just paying the minimum balance. That's what you want to do. That will keep your credit intact. It will keep your score high, if not push it higher. Now, the debit card. The debit card it's not a credit card. What it is, it's linked up with your checking account. And what it does, that takes it directly from your checking account. So if you have $100 in your checking account, you can use the debit card. It's going to take, and you're buying $30 worth of gas, comes directly out of your account. Now you have $70 left in your account. That's what it is. It comes directly from your account right away. All right. You don't have to pay any bills. You're not going to receive a bill. It just comes directly from your account. The one challenge with the debit card is you have to make sure that you have enough money in that account. It's not like a credit card where if the bill comes in, it's $100 and you only had $50 in your account, you can use that credit card to pay for the bill. If your bill is $100 and you only have $50 in your account, you cannot use the debit card. It will be rejected. So the difference that you have is the credit is you're paying for something in the future. The debit is it's right now, right here and now. Does anyone have any questions on these as I'm going? No questions? Thumbs up, thumbs down, nothing? Everybody understand everything? Thumbs up, thumbs down. Question, 2 questions, or are these just 2 thumbs up? Okay, So everybody's got everything down. All right, I keep talking about a credit history and a credit score.
Kayla, are you picking up here?
Yes, I am. So the first thing, again, I'm Kaylin. Okay, what I do, I work in the branch. I work as a banker, and a huge part of my day is talking to people about how to improve their credit, how to maximize their credit. Maybe they already have credit, but they want to make it better. Maybe they don't have any credit at all, and they want to find out how do they get it started. Dennis already asked her questions. That's where I was going to start. But
Okay.
here's what I'm going to do. I'm going to have the same conversation with you about how do we get started, but I'm also going to give you information about what to do if you find your credit when you develop it is stagnant and you're like, what do I need to do, or what piece am I missing to make progress? Okay. So I want everyone to imagine that we're there, or we're sitting in a circle. I want to invite you as I go along, because I'm going to go over a lot of very detailed things, to shout out ideas, shout out questions. I'm going to ask you questions. And if you feel more comfortable, if you want to just raise your hand there, someone stop me and let me know when you have a question, okay? All right. So we talked about what is credit and what is debt. Those are important concepts, but in order to be eligible for debt, in order to be approved for credit, you have to start with what is credit history and what is a credit score, right? These are key terms. You have to have some sort of record in order to be eligible. So the first term we're going to start with is credit history. And we know we're talking about credit, right? That's the point of this workshop. So we're going to focus in on the term history. So I'm going to ask everyone there if you have any ideas. Focusing on the word history, what do you think that indicates? Or what do you think is going to be on record? So let me know if anyone has any ideas. All right. So credit history, put simply.
We do have a question.
Go ahead. Yeah, go ahead.
Yeah, go ahead and ask. Yeah. The purchase history will be on history. This is a question. You mean like you buy something from store? So what do you say?
The question was, what would be on the history, right?
Yes.
I said past purchases.
Past purchases. You mean at any store? Like you buy something at a store, the history, right? Can you ask an example?
I'm sorry, I didn't hear the question clearly.
So anything will be in credit history.
What would be in the credit history?
Yes.
I said past purchases, like big purchases.
Did you hear that? She said big purchases.
Very close. All right. So what's there? But what it is your credit history is going to keep track of, did you pay your bills? Okay, it's going to keep track of, you have 3 credit cards, you have an auto loan, you have a mortgage. Did you make all of payments? Okay. Not paid or not paid on time. Okay. Now the next one, score. You might have already heard a lot about a credit score. What do you think score is going to indicate? Ideas make me happy. So if you have one, shout it out. But on the next slide, it's going to say, well, score is a standardized measurement of the potential for a borrower to repay debt. So we need to be able to have an unbiased standard in order to understand who that borrower is. All right, how do they use credit? How responsible are they? How likely are they to repay? So you can have a low score. You can well, what's a bad score? Or what's a good score? Okay, and that really depends. Generally, different things will require different. Frame. This is what a credit report looks like. Okay, this is where who are you? How much money do you owe? How much history if you one child. All right, the report date 2006. And as we look over the under personal information, this is a pro tip. I want all of you to remember this because it's going to at some point come up and it's going to help you. All right. If you apply for credit and your address does not match, there might be concern about, well, information's not matching. So we might need to verify your information. The address on file that's reporting to credit bureaus often is the address that's associated with your billing statements on different credit accounts. You need to, if you move, always update your address. All right, that's my pro tip for you is if you ever move, always remember to update your address with all of your creditors. And your creditors are anyone you have a loan with, anyone you have a credit card with, okay? All right, the next one we're gonna look at is potentially negative items. These are referred to as delinquencies. All right, if you ever have something come up, you want to change this to say paid as agreed. That's key. Now, 1st, 2005. The report date is January 1st, 2006. So it's very recent, okay? These will stay on your credit for 7 years and they will cause you to lose a lot of points. You don't want to lose any points, okay? And then look at that, delinquent in collections for 120 days. There's 30 days, 60 days, 90 days, more than 120. The older that gets, the more points you're going to lose. So what you want to do is you just generally speaking always want to monitor your credit and never lose time with protecting your credit. And then look at that, it's only $35. So it was very, very small. We don't want to lose a lot of points for something that small. All right, and then the next section is accounts in good standing. We want these. These develop payment history for you. Payment history is the #1 factor in your credit score, okay? If you think of a pie, your payment history is the biggest slice. We can't get started with building credit without payment history. It's crucial. So sometimes, right, if you get student loans, once you start repaying them, you're going to have payment history. This is an account from 1998. It's old. There are a lot of years on this account. The older that account gets, the more points you get to your credit. And then look at that. We're going to do thumbs up for if we see credit limit $1,000. High balance says 129. So right here, this is a line of credit. It's a credit card. It's always referred to, and this is the second biggest piece of that pie, credit utilization. If you have excellent payment history and excellent utilization, you will maximize your score. If you take the 129 divided by 1,000, you're at 12.9% utilization. So if you do anything, 1, pay on time, 2, pay in full. But if you can't pay in full, I want everyone to promise that they will always keep their utilization under 10%, because that is considered excellent utilization. And that is how you're going to maximize your score now, later, forever. Okay, that's the key. That's the golden rule. What you will do is, if it's a line of credit, every month, every 30, 31 days, there's what you spent during 21 days. This is a best practice. This is a life hack. Once your payment date comes up, pay it off and put it away for a week. So I know we said it's not a record of every transaction, but it is a record of every payment. On your statement date, which is generally a few days after your payment date, the credit bureaus are going to go in and record and look at what was your balance on that date. So that week-long period is how you're going to protect yourself from having a higher balance report on your credit bureau, and it's going to protect your credit utilization. All right. If you remember that, it will help you so much in the future. All right. That resting period from payment date to a week after. Now here, there's homeowner credit services next to it. This is high utilization. Okay. So this is a closed account. That's not helping credit. Okay. That could hurt your credit by closing a credit account. The credit limit was $1,000 and the high balance is $3,228. So it's not 10%, it's not 30%, 50%. This is at about 300% utilization. This could hurt credit, okay? Now it didn't get sent to collections, but that doesn't necessarily help credit. Your payment history will stay on your credit for 5 years, okay? And then below that, request for credit history. Those are credit inquiries. Every time you apply for credit, it's going to be recorded, and there's going to be a record of you asking for credit. The more inquiries you have, the more points you lose from your credit, and it stays on your credit for 2 years. Okay? So we went over all of the pieces. There's a lot. So I'm going to pause. If anyone has any questions at all, ask me, because this was a lot of information on one slide. All right. So on the next slide, oh, I see a hand.
Okay, Owen, go ahead, your question.
Is it possible to increase the credit limit? Wait, can you hear me?
A little hard to hear, so if someone can repeat it.
Yeah, so Owen's question is about, is that possible to increase the credit limit?
Absolutely. If you have a low credit limit to start, it does not mean that's your limit forever. Okay, so that's an excellent question. Not everyone knows that. So if you have a credit account for generally about a year or more, one of two things can happen. Your creditor can offer you a higher limit. There are some creditors that will just do it without you asking. And they'll base that on how responsible you've been with using your credit option. Okay? Or the second option is you can ask that they raise it. All right? You can always go in and say, I'm not happy. Can you please increase it? But you generally want to wait about a year, okay? Because they're going to base it on how responsible you've been, and you want to have that history of it. Now, that also means be very careful by protecting your credit score and using your credit accounts responsibly, because they can also decrease your limit if you don't use it responsibly, because they'll get scared. So that's absolutely an excellent question. And yes, you have that power. Anyone else? All right, so here's the impact, okay? If you don't use your credit carefully, it's going to cost you money. And here are some examples of how it's going to cost you money. So utility companies, right? We have PECO, PGW, we've got the water department. They will do a credit inquiry. They're going to pull your credit score to see if they want to give you access to utilities and make it easy for you. If they don't get a strong score back, or they're unable to pull your credit score, they can ask you to put a deposit down. So now you have to pay money to get access to utilities. And my rule of thumb is never pay money for something you shouldn't have to pay for, okay? We don't want to make anyone else rich. We want to save something for ourselves. So insurance companies. Dennis already mentioned it. There's auto insurance, home insurance, renter's insurance. You can be denied a policy. You might not even get the policy if they don't like your credit score. But let's say they approve you, but you have low credit. You will pay twice as much with poor credit than if you had excellent credit. And you're going to be paying for that insurance for many years. It could be 50 years. It could be 70 years. It could be however long you're in that home, okay? So think about what paying 2 times someone else would cost you. Landlords, all right? If you find the most amazing apartment, it has everything you could possibly want. It has a dishwasher. It has an in-unit washer dryer. It has an excellent location, right? It's right where you want to be. It has all the space you want. You'd be heartbreaking. It will always take time to develop it, and it will take time to improve it. I want to know more. I'll talk to you in depth, in detail about the power that you have to control your own progress. But it will always take time. So if you find that apartment, it could be gone by the time. Intimidating thing, but you're apply for a job. They want to know you're going to be a responsible employee. And working for the military. They're all going to look at that, and they're going to base a lot of their decisions off of, do we think that this applicant will be responsible? So here it's, you want the apartment, you want the job, you want to save money, you want utilities. This is crucial for all of those things. Okay. So on the next slide, we're going to talk about, well, how can you get started? All right. There are different factors that make you a good credit risk. There's capacity, which is the ability to repay. Can you repay? You might have excellent character, and you know that. But what they're going to need to know, will you have the ability to repay? All right. They're going to look at, have you made your payments recently? Have you made your payments looking at your payment history to show that you have paid. There's capital, which means what assets do we have? And assets means, right, it's something to us. It's something that we own. It could be cash. It could be other properties. It could be all sorts of things, but it's something that it has value and it's ours, okay? Character. That's going to be a review of your credit history, all right? That is the responsibility we talked about. How responsible have we proven to be? And then collateral, there are loans and credit options that are unsecured, which means you're not putting any of your assets down, right? You're not saying, you would say, here's my collateral on the value of my asset, my home. That's what collateral would mean, okay? It can affect different products, different credit solutions will be based on the ability to do that, okay? That's how a mortgage works, all right? You get the loan through a lender and your home is collateral. And as you pay down, the more you pay down, the more it's yours, okay? All right. So here's an important term. We need to look at a term called annual percentage rate. And it's meant to be a standard term to help you compare credit options. You need to know exactly how to compare options from different lenders. We need to all speak the same language and give measurement so you know what's a good option and what's not a good option, or what's your best option. So that's what this is. So it's the cost of borrowing money on a yearly basis. All right, so that's the annual part, including both interest and any fees paid. Okay, some credit cards have annual fees, some lines of credit have annual fees, and some don't. So you want to ask that question. Credit card companies are allowed to offer special low-term rates that are available only for a limited time. If you have a new credit account, a line of credit, sometimes they'll offer you 0% for X number of months, okay? Some options will offer you 12 months, 15 months, 18 months at a low promotional rate. So that's one of the things you also want to compare, okay? But you also want to know when that's going to expire. That's key, because you want to have a plan after that promotional period expires. All right. Rates can change, right? They don't change daily, generally speaking. They don't change monthly, generally speaking, but maybe quarterly, maybe every 6 months. They're all different kinds of rates. So you want to know, is it a fixed rate and it'll stay the same forever? Or if it's variable. So that means your rate could go up. It could go down, but it could certainly go up if it's variable, and that's a risk. And if it goes up, that means it's costing you more money. That expense is yours. So if it risks going up, now you're going to pay more money for the same thing that you had a month ago that costs less. All right. And then there are different interest rates for different things. All right. So if you have a credit card and you make a purchase, that's one way you can use a credit card. Now, if you pay your credit card in full every month, you're going to avoid interest. But if you don't, you might pay interest. If you use your credit card in an ATM, it could go through. It's a last resort. And if everyone has a better option, I don't want you to pull it out. I don't want you to use your credit card in an ATM. It's generally a much higher rate, and you might start paying on that right away, okay? I don't want you paying for that. So here are some of the fees you could pay. You have annual fees. You want to know that. It could be $0, it could be $25, it could be $50. There are some credit options that have annual fees that are very high, right? They might have amazing rewards and perks, but they would say, in order to get this card, you're going to have to pay us a lot of money annually. Late fees. If you don't pay on time, the amount that you owe, add more, right? They're going to charge you an extra fee because you didn't pay on time. So now there's interest plus late fees. All right. Now it's going to list balance transfer fees. I'm going to explain what that is. Oh, I skipped over the limit fees. That's on me. So over the limit, on our credit report, we saw a credit limit of $1,000. That was over the limit. The balance was higher than the limit. So associated with that, and it's expensive. There are some options that it might not have an over the limit fee, but you need to know if it charges you, right? That could be 28, 30% interest. It's very high. Balance transfer fees. If you have a balance on a high interest product, it could be charging you 20, 25, 28%. That's a lot of money. So you might want to find an option that offers you something called a balance transfer with a low promotional rate. Let's say you owe $5,000 and you want to move it to something that's going to give you 18 months at 0%. To move it is called a balance transfer. 0% to pay off $5,000 for that amount of time, that's great because you can come up with a plan to pay it off, but you won't necessarily do it for free. That's what this charge is, okay? So they might charge you a percentage to do that, and you want to know what it is. Cash advance fees, that's putting your credit card in an ATM and taking that money out. And that's not a necessarily pay in full and not pay interest on that. You're going to pay interest to do that cash advance, and it's going to be very high and very expensive. And then foreign transaction fee. So if you use your credit card outside the country, they might charge you 3-4%. There are some options that waive the foreign transaction fee. So let's say you get an opportunity to take an amazing trip to 3-4 countries. You're going to be gone for an amazing amount of time, and but you come back and realize how much you paid in fees. Before you go, you want to ask the question, whatever card you're using, am I going to pay a foreign transaction fee? Some cards do charge it, some don't. So know which one you have. Those are some of the things that you can ask about to compare, is this the best option for me? All right, so then the grace period. The grace period is the period of time during which no interest is charged for purchases made on your credit card. Okay, so yes, pay in full every month. Okay, it can get confusing, right? Watch your mail or watch your statements online. Okay, payment dates can move because some months have 30 days, 31 days, 28 days. Okay, so watch for your statement online and then just make sure you pay on time. But without a grace period, the credit card company can start charging interest from the date that you make a purchase with your card. Generally speaking, that's the key. If you pay in full, you'll be okay. But remember, there are certain transactions where it's going to start charging right away, or certain lines of credit where it's going to charge you per day. All right. So you might not have a grace period. Well, at least 21 days before the payment is due. Remember, month if you choose to get it through the mail, because if it doesn't get to you, you need to call up and say, hey, I didn't get my statement. You're already losing time because it gets sent in the mail, and then you need the information. So every month, make sure your payment gets paid electronically and Okay. Many credit card companies do not offer a grace period for cash advances or when you transfer balances to a new card. Now, if you do a balance transfer, generally you want to do that on a promotion. You don't generally want to do that on a standard rate. But if you do that, just know, generally speaking, that will not have a grace period. So interest will be charged on that. All right, interest is charged beginning on the date of the transaction. All right, so here's where we're going to do the math. I gave you all the tools to know what all the terms are. We're going to think about an example because I want you to know how much this costs you, right? If we don't use credit responsibly, how much is APR, annual percentage rate, going to cost us? So we're going to think about a credit card with a $1,000 balance, okay? On that $1,000 balance, let's say it's a 24% interest rate.
Jesus.
All right. This is an annual calculation. All right. That means for the year on $1,000, you would pay $240. So during the course of that month, if we take 240 divided by 12 months, you would be paying $20 a month in interest. All right. If your payment, your minimum payment for that month is $30, you're only paying $10 towards what you owe. And then you're paying your lender $20. That's really expensive. And that's money you're never going to get back. So again, reminder, pay in full. All right. That is going to be on any line of credit. That's your credit card. That's how it works. That's how you know what you're going to pay. It's going to be based on your balance when that statement comes out. So if your balance is zero, then you can't take a percentage of zero. So if you put it away for that week after that payment date, that's the best way to protect yourself from paying money on that account. All right. So why this is important. If you're going to carry a balance on a credit card and not if you expect to pay okay. Yes, there are rewards associated. However, generally speaking, unless you're going to make excellent use of those rewards, you probably won't want to pay an annual fee. Do you plan to use your credit card mostly for purchasing goods or services, or to withdraw cash from an ATM when needed? All right, I don't want anyone pulling it out to do a withdrawal in an ATM. That's not how we use our credit card. But if you have to, know which one in a pinch you would pull out. Customer service experience. Can you access information and pay credit card bills online? This is a credit account, right? It has impact on your credit score. If you don't get good service and they don't give you solutions when you need them, then that's serious. That can impact you. That can impact your ability to have the score that you want and need when you go to buy a home. If you want to make a payment and they're making it very hard for you to do that online or over the phone, well, then that can impact your ability to get the home you want. So the service you get is very important. How easy on your card. There's a lot of fraud. Okay, I'm going to tell all of you, don't use ATMs at night. Don't use ATMs outside. But sometimes fraud happens. Okay, there are a lot of smart people out there that are finding new creative ways to get access to your information. So when you use and you make sure that you have that fraud protection, you file a dispute to get your money back. That's very risk. You don't want to be using someone with your trusting them to give you your money back if it wasn't someone spent $800 on your credit card. You want your $800 back because it wasn't you. So getting that level of service and protection is very important. And then credit limit. Okay. On your relationship, depending on how well they know you, how much information they have, might offer you a bigger limit. And that limit, the bigger it is, the lower your utilization will look, assuming you spend the same amount. And I made everyone promise me, generally speaking, 10% or less on credit cards or pay in full. Your credit limit is going to be credit score. Those are the two biggest factors, and I want you to remember them, okay? So does anyone have questions? Because we covered a lot of really detailed things on those slides. Okay, so here we're the interactive part. So Xida's going to jump in, and he's going to ask you questions. We're going to apply what we know.
Hello, students. I want to make sure everyone can see me and hear me clearly. So I do need your attention. In the past 1 hour, I do have some questions for you. So first of all, can we have a volunteer tell me what is a credit card? I just want to do a quick read.
You owe money to the bank, whatever.
Can you repeat that?
If the car used to buy stuff online, but then you're basically someone else's money, so you show them the money. That makes sense.
Okay, that's very good. So normally that's correct. A credit card is it's a card you can use, and it will allow you to borrow money and use it. All right. My next question, Kaylin just went over what is a credit score. Can someone give me a little bit explanation what is a credit score?
Can you say it louder?
Credit score is what you did before with the credit card. Now what you purchased before, do you pay it back or something?
Mm-hmm.
Okay. Any other comments about credit? Okay, go ahead. Come over here. Yeah. Say that.
I think the credit score is a score that uses your credit limit. If you have a low credit score, your credit limit might be very low.
All right. All right, all that is very good. So a credit score is a standardized way to measure how trustworthy you are on credit-wise. So it will give you a score, depending on how high or how low it is, it affects how creditors see you. So the credit score is based off a credit report. Can someone let me know what is on a credit report?
paper that the bank sends you monthly, and it shows you the history of your purchases and your credit score.
Yes, very good. The keyword there is the history. Your credit report will have the history of what you owed, what you have, and how you have been making your payments. All right, that's very good. Looks like all the information Kaylin and Dennis showed earlier is very effective, and you have a general understanding about credit. Now, I will need 4 volunteers. Help me go over some scenarios. We are going to have some conversation about those scenarios, and we are going to discuss are those person good credit risk or bad credit risk? And I want to know why and what do you think? Can I have a first volunteer? Just help me read this first slide here.
Can you help me read the question?
Read the question.
Yes.
Is this person a good credit risk? I
Mhm.
got a credit card 1 year ago and maxed it out. I've been making the minimum payment every month, but I've been a little late a couple times. I just got a second credit card for emergency, and I haven't used it yet. I'm nervous about my credit report, so I haven't used it yet.
All right. So I need your thought on this.
So any comments about this question? Is this person?
Yes,
a
do
good
you
person?
think this person shows a good credit or not? No? I hear some people saying no. So is there anyone want to share with me why do you think no? Yeah, go ahead.
It's because she maxed out her payment and she's late a couple times. Yeah, but since she's late a couple times in the payment.
Yeah, very good, very good. I hear that you mentioned there are a couple of late payments. That's crucial. So when you use your credit, make sure you do not have late payments because those late payments will be shown on your report, the credit report. Whenever you have a late payment, it shows on the history. So this person will show as a bad credit risk because of those late payments. Does anybody else have any other thoughts? Is there any other points you see in here?
She got a second credit card even though she hasn't paid her debt yet.
That's one of that. So she already maxed out the first card. Based on what Kaylin introduced earlier, that's called high utilization. So you use a lot of your credit and without paying it back. And now you are trying to borrow more. It doesn't show a very good credit to creditors. Anything else you see here? All right, so she maxed out the first card, applied for a second card, have some late payments. So there's also one thing we need to notice here. She's nervous about the credit score, so she did not check her credit report. That's not a very good way to manage your credit. Even though you might be nervous about your credit score, you might think my credit score might be bad. The best way will be try to manage it, try to see how good or how bad you are. And then from there, you can seek help or you can manage to improve your credit step by step. Instead of using the second card as an emergency fund, there are multiple ways we can help her out. For example, Kaylin introduced there is balance transfer. If she get a good card with an introductory rate on balance transfer, we can help her out that way. She can get a second card, do balance transfer, and then she'll be out of this trouble. There are many, many other ways we can help her. So that's one of that. I do need a second person to read me a second scenario. Do I have a volunteer?
Can we try that?
Okay. Is this person a good credit risk? I recently finished college with $15,000 in student loan debt and started working. I make enough money to cover my loan payment. I'm thinking about getting a credit card to free up some spending money in my budget.
Very good, very good. So what do you think? Do you think she is a good credit risk? Just, I'm opening this question to anyone. If anyone have any thoughts, you can just raise your hand. Either she is a good credit risk or not. I'm sorry.
Alright, so this person is a good credit risk because they make enough money to cover their loan payment.
Okay, that's a good point. So besides of how you use your credit, there's also another reason we look at credits. It's why you're borrowing those and how you're using your money you borrowed. So in this case, the loan we took out is a student loan. That paved the way for higher income. That paved the way for your education. That's definitely a good loan. And after that, she is going to apply for a credit card for her daily expenditures. So generally speaking, I would think that is a good credit risk here. So she has been responsible making all the payments, and then this new card is going to be for daily usage. So we do not see any risk here. We do not see any problem we saw in the last scenario